Good day fellow traders and value investors, and welcome back to another video. Just for reference, the goal of the channel is to analyze stocks as a non-professional and share my findings with you. I also want to make more informed decisions when buying a stock in my speculative portfolio and hopefully find stocks that can be added into my value investing portfolio. In today's video, we'll look at Acomo. On the surface, Acomo looks cheap, low PE, steady business, the kind of stock that screams undervalued. But does the story hold when taking the stock through my 3 case scenarios? In this video, I'll do just that. We'll take Acomo through the scenarios, take the risk into calculation, and see what is Acomo's annual yield. Let's get into it. Acomo is a global food ingredients company focused on plant-based products. They buy, process, and distribute food ingredients like spices and nuts, edible seeds, organic ingredients, and tea. Acomo owns a group of mostly autonomous specialist ingredient businesses. The parent allocates capital, provides financing, manages risk, and looks for acquisition opportunities while the operating companies run their own commercial activities. Management has described this decentralized model before as combining entrepreneurial agility with group financing, capital allocation, risk management, and business development. Acomo's acquisitions seem designed to strengthen existing segments rather than reinvent the company, add geography, add customer access, add processing and packaging capabilities, deepen specialization in plant-based specialty ingredients, and improve scale so the group can handle volatility and regulatory complexity better, all while keeping a manageable leverage ratio. Acomo operates through 5 segments: spices and nuts, organic ingredients, edible seeds, tea, and food solutions. The group operates in 19 countries, is active in more than 100 countries with more than 600 products. Acomo is a steady compounder. Growth is driven by organic demand, pricing, and small acquisitions. It's not driven by disruptive innovation or market share domination. Now that we learned a bit about the company, let's have a look at the numbers. In terms of financial, first we'll look at the shareholder return. Acomo paid 38.5 million in dividends to shareholders in 2025, and that's an increase of 13% compared to 2024. I couldn't find any mentions of share repurchases, as it seems the company prioritizes dividends and strategic acquisitions as its primary method for returning value to shareholders. Management labeled 2025 as a record year, and that was mainly driven by the volatility in the commodity prices and also by the currency volatility. In terms of leverage ratio, it's at 2.6 for 2025, and it's been impacted by the increase in the working capital. Over trading view in traditional manner, revenue has been up over the last few quarters. We'll change to annual. Revenue has been up 7% year over year, and the same was in 2024. We can also see that there is a trend of revenue growing year over year from 700 million to about 1.46 in 2025. Steady net income increases as well over the years to up to 73 million. We have to take it with a pinch of salt. The last year was a stronger year due to the volatility in the commodity prices as well as the currency exchanges. Over to the balance sheet. We'll expand the total liabilities and we'll see that the debt has been manageable, it's been up and down. In terms of long-term debt, we can see that there is an uptrend. The long-term debt is currently at 125 million. We'll switch to statistics and change to annual straight away. We can see that the company is currently selling for a PE of 10.73. Acomo doesn't work in a high margin environment, but even so we can see that the margins have been steadily growing from 10% to about 15-16%. Again, 2025 was a very strong year for them, so we have to take that with a pinch of salt. Net margin has been steady at around 4%. It's been up and down over the years, but the management managed to keep it at about 4%. And then a decent current ratio of 1.73. They have 1.73 euro of current assets for every 1 euro of current liabilities. And then debt to equity 0.88 is slightly higher than my ideal number of 0.50, but still manageable. So Acomo isn't a flashy growth stock, it's a steady operator. The real question isn't whether it can grow, it's whether it can protect margins in a volatile commodity world. We'll first look at the intrinsic value using 3 calculators: Warren Buffett, Phil Town, and Peter Lynch's calculators. Warren Buffett's calculator is using the historical book value per share. These are the numbers that I found for the past 10 years. and it takes into account the discount rate, the 10 years notes, and using this method we get an intrinsic value for Acomo of 34.52 euro per share. This is euro since the stock trades in the Europe. Piltown calculator is more of a growth story type of calculator. It uses the EPS growth for the next 10 years. I use a more conservative growth, 7%. Short term is the growth is projected to be between 10 and 11%. So using this calculator we get an intrinsic value of 6.37, way lower than what it trades at the moment. And then Peter Lynch's calculator uses the price to earnings growth. I use the same growth of 7%, and using that calculator we get a fairly valued rating. So using the three calculators we get a range between 6 euro per share and 34.52 euro per share, and a fairly valued rating using Peter Lynch's calculator. For the three case scenarios I use commodity price environment as the key driver, because Acomo earns more when markets are volatile and tight and less when things normalize. I use this multiple because multiple of 10 is bottom of the historical range, multiple of 12 is right between that historical range of 10 to 13. The P multiple of 14 still below premium food companies of 18 to 22x, but reflects strong growth, higher quality earnings. So for a bear case scenario, if we see no EPS growth, commodity prices normalize, edible seeds recover is weak, tea remains structurally challenged, we could see EPS of 2.47 euro rather than dollars, and the stock could be selling for 24.70 euros. In a base case scenario with EPS growing at 4%, spices and nuts continue strong, Manuzzi contributes gradually, working capital normalize, we could see EPS of 2.78 and the stock could be going to 33.34 in 3 years. And with EPS growing at 7%, commodity volatility remains favorable, spices and nuts scale aggressively, margins stay elevated, we could see EPS of 3.03 and the stock could be selling for 42.36 in 3 years. Putting it all through a probability weighted table, see we get a total return of 28% if we buy it and hold it for the next 3 years, making it annually of 8.54, add that about 5% in dividends, that's about 13.47. Not too bad, but we need to take the risk into calculation as well. Let's now turn to the risk factors and see a few of the risks that I've identified. First one is the commodity price volatility. Acomo deals with cacao, coffee, seeds and nuts. Prices fluctuate a lot and that means that the margins can compress quickly. Even the management mentioned that in the presentation that there was a difference between H1 and H2 since 2023. Then there is working capital risk. Because Acomo buys inventory upfront, holds large stock, so when the prices rise, inventory becomes more expensive, which means they need more cash or more debt. And suddenly, a good year can actually put pressure on the balance sheet. I could see increase in the working capital mentioned several times in the investor presentations, in annual reports, as well as the investor call. There is also geopolitical and trade risk, tariffs, export restrictions, supply chain disruptions. These directly affect margins and volumes. Another risk is acquisition execution risk. Acomo expands by acquiring other businesses and expanding in other regions. And the risk is that synergies can take longer, integration can be messy, and sometimes they just don't deliver. Manuzzi was the latest acquisition. They completed the acquisition in November 2025, and they've already been impacting the sales slightly. And finally, Acomo is a low margin business. That means small mistakes, small mispricing, small execution issues can have a big impact on the profits. I gave Acomo a base score of 3, it's a bit conservative, it's more like 3.54, because its earnings can swing depending on things they don't fully control, like commodity prices, currency and inventory costs. I subtracted 0.25 because current ratio is above 1.5, and I didn't add it or subtracted anything because debt to equity is between 0.5 and 1, and that gives a total score of 2.75. Taking this risk into account, we get a total risk adjusted return of 6.06, which means Acomo is presenting us with 6.06% return annually if we buy it and hold it at current prices. That's not stellar return, but it's not too bad either. With the financials, intrinsic value and the risks covered, let's now turn to the charts. First thing that is obvious is that the stock is in an uptrend. The moving averages are currently pointing upwards. Momentum is below, it's above 50, it's above 0% first, and then it's above 50 as well. There's been strong momentum in 2025 and then some strong momentum in recent months in 2026. But momentum's cooled down for a little bit. Also, the ATR dots are printed below the candlesticks, which confirms that the momentum is upwards and the stock is in an uptrend. I'll zoom out a little bit and I'll just talk about a few of the levels. First is this 15 euro per share level. The stock broke after the pandemic. It went with some momentum upwards. It broke through this 19 euro per share level, but then it found some resistance and it dropped all the way to this 15 euro per share level. It bounced off of it, it drove all the way to 19-20 euro per share, where it found further resistance, and then it dropped with some momentum downwards all the way to this 15 euro per share again, and then it bounced off of it and it consolidated in this current uptrend. For me personally, full disclosure, I have a full position in the stock. I started buying in about 2023, April 2023, the first position, and the average price that I bought it is 1936. I obviously bought it at 36. I obviously bought it at this $21 euro per share level. I also bought it as it was going down, so then average is 19.36. And then one final thing that I'll do, I'll just put the risk reward on the table based on our 3 case scenarios and see how much more upside there is for the stock right now. So profit level is our bull case scenario, which is 42.36 euro per share, and then the stop level, which is our risk, is our bear case scenario, which was 24.7 euro per share. Putting it on the chart, we get at about 11.17 risk reward. It's not too bad if the stock holds. There's a couple of things to be aware as well, is that if the stock manages to break this level, then I think this risk reward is justified and the stock is likely to continue upwards. If the stock doesn't break this level, finds resistance, and then it bounces around this area, then it will be a consolidation area. We can build a further bigger position, but then the risk is that if the stock comes to this 23.70, tries to break through it, and then it eventually manages to break it, then it's likely that it will continue downwards, and it's possible that it will come all the way down to this 19 euro per share level. So the biggest message from the chart is simple: the trend is up, momentum has cooled, and the price is near resistance. In terms of risk reward, based on the bear base bull case scenario, we get 11.17 risk reward. So there you have it, Acomo stock analysis. And Acomo offers a risk reward ratio of 11 if we use bull as the profit level and bear case scenario as the stop loss level. I own the stock in my intrinsic value portfolio. I had it in there for a few years. It looks like I first opened a position in April 2023. I asked at the beginning if the undervalued story holds when taking the stock through my 3 case scenarios. And the answer for me personally is yes, it does. This is the first time I take it through the scenarios, and for me personally, the conclusion is simple. I intend to keep the stock. I'm not planning to sell it yet. It offers a 5% dividend yield plus 6% risk adjusted return, a total of about 10-11% yield. And of course, this is non-advisory, this is just my opinion and my analysis. I hope you enjoyed this analysis and found it useful. If you did, hit the like button, consider subscribing, and let me know in the comments what stock you'd like me to analyze next on Fundamentals in Motion. Thanks for watching.